Great. Hi, everybody. I know that's kind of one in, one out, but thank you very much for joining. We're just 1 minute now into the European Open, and I can say that stocks in Europe have opened higher today. So we'll get started because we are just a couple of minutes over. But it has been a really fascinating week. We've had obviously Europe absolutely dominating headlines. Now just bear with me 1 moment. I'm just going to test my camera. And I'm hoping here that you can see a 60-minute euro-dollar chart. So I assume that you can all see that and that we're all good to go here. Yes, so Europe has been very much dominating everything. We have had, what a week really. Not only have we had various pre-summits and meetings, we had Geithner meeting, the US Treasury Secretary meeting with the German Finance Minister yesterday, but we also had that S&P action. So the S&P, Standard & Poor's credit rating agency, putting 15 out of 17 Eurozone members on review for downgrade, which also would impact the EFSF. They held no punches at all. But we really are gearing up for tomorrow. Today, we believe, is going to be very sentiment driven. As you can see here, Eurodollar, if we actually look at a short-term chart, so a 15-minute chart, Eurodollar's had a fantastic start to the day. It really, really has. It recovered fairly well yesterday after hitting that kind of below 33.50. And since then, really kind of bounced back and does look quite nice, certainly on a shorter term basis. If we start just going through the charts here, as you can see, the 30-minute chart again, still looking good. And today we had another good start for the euro on the back of some expectation that Europe is going to come up with these kind of big bazookas. Everybody's looking for bazookas these days, and that is what people are looking for. Hasn't been able to hold gains above 134.50, as you can see here. It's run into a little bit of congestion. However, there is good support at 134.30. Now that's where we're holding right now. That's the 100-hour moving average. I'd just also like to draw your attention to the MACD and the RSI. These are also pointing higher and still look fairly good. So as you can see, the MACD has really worked treats really here for this. It's really when it turns down, it does tend to kind of track Eurodollar very, very closely. So 134.30 is holding as resistance at the moment, but then below there we have 134. But the one thing that I would say right now is that between kind of 133.70 and 134.50, there's an awful lot of support on the way down. So we think we could be in kind of a tight range trading condition. So we saw a huge jump up. Actually, if we go back to the 15-minute chart, you'll be able to see this better. Here, so we saw a huge jump up. This move here was on the back of those new details on potential big bazookas, say whether or not there's an EFSF, ESM joint rescue package, whether the IMF is going to get involved. That all came out late last night. I mean, that really did help Euro to kind of jump higher during the Asia session. Hasn't, again, managed to sustain those gains, but it has, as I said, there is a lot of support, and there is a lot of support on the way down here, certainly between 134.50 and 133.70 to 80. That could potentially be a range that we may be stuck in for a little bit of time. It wouldn't be that different from the ranges that we've seen. We've basically been in about 100 pip range for the last couple of days. So we don't think that will necessarily change today. But as I said, we are very sentiment driven. We are moving towards tomorrow, which is the start of a key 2 days, possibly two of the most important days certainly for Europe and potentially for kind of Euro traders of the year so far. So it really is serious. Tomorrow we have the ECB meeting. That takes place at, the announcement will be at 12:45 UK time with the Draghi press conference at 1:30 UK time. That would be 8:30 US time. They're expected to cut base rates or cut the interest rates by 25 basis points. There is a risk that they'll cut by 50. If they were to cut by 50, it would have a funny impact on the market, really. It go back just a little bit. Let's go back a month. Actually, I'll I'll use my Bloomberg chart, so just bear with me because you'll be able to see it a bit better. Just to look at what happened let's just take a look at what happened to the euro at their last meeting. Sorry, bear with me. It's playing up today. Okay, that's a bit better. Sorry, bear with me. I've got a bit of a technical glitch, but it should be okay. But anyway, just going kind of back to what we were saying. Well, really, it is all about Europe at the moment. It's totally dominating things. It's impacting other countries and what they do. We had a very, very cautious Bank of Canada yesterday. We've had some very negative data out of Switzerland as well, which we'll also take a look at. But it really does show you that it is quite, it's a hairy time. It's not. Right, I've got it. Okay, so. One moment. Now, what you should see here, this is a Euro daily chart. So it's a 30-day chart. So as you can see, days along the bottom here. Now, this was the last ECB meeting when they cut rates before. As you can see, kind of shot up immediately and then moved around sideways for a while. So there wasn't a huge move, about a 100-pip move. It had been trading kind of above that 135 zone. So as you can see, just looking at it, just taking a look at this chart from where we were a month ago when the ECB cut rates to where we are today, they're fairly weak. You see, it hasn't collapsed. We haven't seen capitulation, but it is looking fairly weak. Obviously, this tallies with kind of a month of that utter turmoil in the Eurozone of failed bond auctions, of huge Italian bond yields. But what it also does show us is that there is, potentially the market, or the currency market anyway, doesn't really know how to digest some of this kind of rate cutting news. So on the one hand, it's good for growth. So part of the reason why the euro has fallen off a cliff, or all of this kind of, massive loss here in euro over the last month, has actually been on the back of expectations of very weak growth. Weak growth would obviously hurt debt dynamics even more. However, you cut rates, you may ease a little bit of pressure on growth. However, you also lose some yield. So the euro becomes less attractive to hold on a yield basis. So its relative yield interest rate differential actually becomes more euro negative. So that's why we think on the whole, one could argue, well, we nearly saw the peak euro there at meeting, and then they cut rates and it caused it to decline again. Well, one of the main reasons why, the decline over the last month was obviously down to kind of stresses in sovereign debt markets. But I would watch that, currencies do love yield. And so what we've seen is, as yields get cut or interest rate differentials get cut, that does tend to weigh on a currency. So, let's not kind of forget that, and let's be very vigilant around kind of 12:45 tomorrow. Again, as I said, the unexpected news would be a 50 basis point cut from the European Central Bank. And now it's also the Bank of England tomorrow, those of you who follow that type of data. Those people who look at kind of that fundamental data will know that it's the Bank of England as well. They announce rates or announce their decision at midday UK time, so that's 7 a.m. US time. They're not expected to make any difference. Now they have embarked on QE already, so they went in October, the beginning of October. They boosted their QE by 175 billion. As someone has just mentioned, they've also they've already put in place measures it's a collateral kind of term, or it's a lending facility really, that makes it easier for banks to get access to sterling lending, using collateral that other banks may not accept, essentially. And that was announced yesterday. So, the Bank of England have already kind of they've put in place their liquidity measures. Now, the one thing we do also expect from the ECB and that we're also looking out for is any signs of, but we do expect them to provide more euro-based lending akin to what the Bank of England has done this week. So we certainly expect them to do that. Added to that, Mario Draghi was very, very cryptic last week. He said that he wanted a fiscal compact and new fiscal rules before the ECB could step in and help anymore. So those of you who've listened to this webinar before will know my thinking on this week's EU summit, that essentially the EU summit is dealing with kind of very long-term issues. So things like kind of closer fiscal unity, et cetera, et cetera. What we need is to ease it where we are now to get to that fiscal unity. There's going to be a time lapse, right? Because it's quite difficult. It's complicated. It's going to require 17 governments to ratify treaties, probably 27 governments if there is a treaty change. Apparently they're saying there's not, but look, trust me, there's going to be a lot of time. It's going to take a lot of time to get that in place. And expectations that it's going to happen in March may be too optimistic. So what we need is really a bridge to get us from where we are today to that fiscal unity or to that point in the future whereby the Eurozone's finances are kind of more centrally managed. And the ECB can provide that. So that's what I'm also looking out for. I'm going to be listening to that press conference incredibly closely because I really want to find out what is it that the ECB is going to do. And if Mario Draghi, the head of the ECB, is confident that there's going to be some kind of changes to or some fiscal accords within the currency bloc, then what is it that he's going to do? And I think that's going to do two things. That's going to cause risk to rally if he is to announce greater ECB participation at least or support. But the impact on the euro could be quite interesting. Now, some people have argued that the ECB going in, doing QE, so traditionally QE tends to weaken the pound and the dollar, right? It's because the Fed and the Bank of England are flooding their economies with their pound and dollars respectively. Hence kind of your supply demand balance goes all out of balance and the pound tends to weaken. Now that is very, very different for the ECB because the main reason why currencies weaken through QE is that it tends to push down interest rates. So as I said, it's that whole yield effect. Now with the euro, it is interesting because obviously on the one hand we've got the ECB cutting interest rates. However, on a relative basis, they're still higher than they are in the UK and in the US. And on the other hand, you've got QE, but QE in Europe will be kind of a different type of thing because it's trying to balance out the economies in the Eurozone. So it's trying to push down yields in the periphery, say for Italy, Greece, etc., etc. But the adverse side of that, because it's essentially a zero-sum game, is that it will push up rates for Germany and for some of the stronger ones. So the net change to rates could be flat. So we really do have to watch because QE may not have the same impact on the euro as it does on the pound. And I think that's a really interesting dynamic and something certainly worth looking at. Now I've got some other charts I'd like to show you as well. Just bear with me one moment. Oh. Brilliant. Now this is a euro chart, so we're not going to look at that because we just looked at it. I'm going to show you euro Swissy. So the one thing that obviously that you may have noticed with the euro is that it's really been range bound, as I said. You know, in the last 2 days, 133.40 on the downside with 135.50 on the upside. You know, very, very tight range. So where are the trends? That's what everyone wants to know. Well, Euro Swissy has been the biggest mover out of kind of the G10 FX spectrum. And that is largely because of some very weak data, some very weak inflation data that came out of Switzerland yesterday. Their inflation rate is falling at 0.5% on an annual basis. So that's much higher. That is deflation essentially, and something that the S&P will not want. Added to that, there's also expectations that on December the 15th when the S&P next meets, that they will actually increase the floor on Euro Swissy, so increase it to 125. So hence, if you go all the way back We can see that jump yesterday. Yeah, right up here. And that is all based on that inflation data that came out of Switzerland. As you can see, it climbed all the way to 124.40. However, it's since come off. If you look at it on an hourly chart, it has since come off. It is testing this 124.10 mark, which is a 21-hour moving average. So that is a pretty pivotal level. I'd also just draw your attention to the MACD and the RSI. On a shorter, on the hourly, 30-minute, and the 15-minute chart. I'm going back to the 60-minute now. They're all turning lower. So all these directional indicators are turning lower. They are pointing lower. So that just suggests that certainly in the short term that we may see some certainly in the short term, we may actually see some weakness, or may see it kind of make a short-term high at that 124.40 level for Euro Swissy. It does look, as I said, 124.10. There is good support again at 123.75, and then at 123.50. But that still is higher than the 121.50 low that we got to last week. But there is a kind of some expectation now being priced into the market, and this move here is pretty much expectation that the central bank will increase the floor to 125. So it's interesting because sometimes you hear, the Bank of Japan haven't been able to weaken. Apologies for that. The Bank of Japan haven't been able to weaken their currency. Likewise, the Swiss bank has spent kind of 2 years trying to weaken their currency, and they hadn't been able to do it. So why are they able to do it now? Well, it's largely because they've put in very aggressive measures. They've actually put in these floors in place. They've also said that they'll do negative interest rates. All really key things that can weaken the currency. So they've taken much more aggressive steps, and they haven't necessarily had to go in and intervene directly in the FX markets themselves. So that is a key note. But I think because they've done so well at bringing Euro Swissy from parity almost back in August to where we are now by implementing that 120 floor, and it takes a while really. As you can see, that what's been in place really has been respected, and I think investors do certainly respect that 120 level as well. So someone's just asked me a question: how a potential new transaction tax in Europe could affect charts, volatility, spreads, and trends, etc. It's very, very difficult to be able to predict that type of thing. As transaction tax, number one, it's really pie in the sky because it's just been flaunted out there really. It hasn't been, there's been no description, there's been no detail about what it would entail, who would it be for, would the UK include it? Well, the one thing is for sure, is that, the UK would not support financial transaction tax. So there's many hoops to jump through before we get to that one. And really the market impact on these type of things doesn't really impact too much. Now, I'll just show you another chart because it is quite an interesting one. Where it hits, obviously, tends to be in the banking stocks. So if we were to get an announcement to say that on such a date we're going to implement the financial transaction tax, well, that's obviously going to hit profits of banks, and that's where we're going to see it. We're not necessarily going to see it elsewhere. Potentially, you might see it a little bit in the sovereign bond markets because investors are worried about sovereign finances anyway. They're worried about sovereigns having to bail out their banking sectors, and if there's more pressure on bank profits or their profitability, then that could kind of increase chances that they're going to have to, stump up the cash to try and bail them out. Now, I'm just going to show you a chart quickly here, which is, again, another kind of really interesting one, which just really explains an awful lot of what we've seen in FX and elsewhere. So this chart in front of you is the Euro Stoxx 50, and it's the banking sector of that. So it's just the banking sector. So as you can see, basically from the 25th, so basically that was the central bank liquidity injection. Look how well banks have done. Now I'm just going to do a little bit of some annotation on this. As you can see, up nearly 20%. Now that's been led higher by French banks, by Italian banks that were really badly hit over the last month or so, and they really have staged quite a stunning recovery. I mean, that's nearly 20% increase since that central bank liquidity push. So I think a lot of banks were very worried, or a lot of investors were very worried about banks not being able to access funding. There's this kind of psychological market fear of another credit crunch. Now that central banks have stepped in to provide liquidity, that has been considered good news for stocks. or certainly for the banking stocks, and that has led other overall indices higher. So as you can see, taking a little bit of a breather here, but really it all depends now on, firstly, the ECB tomorrow and what they're going to offer banks in terms of euro-based funding, and then also obviously the outcome of the summit, and that matters a lot for banks because they hold an awful lot of sovereign debt on their balance sheet. There have been some good news on that. There has been some good news on that front. It looks like Germany is going to drop its insistence that private sector bondholders need to take haircuts on their debt holdings, and that's really good for the banks because obviously the banks are the main holders of sovereign debt, so it means that they may not have to take losses in for bailed out on their the bonds that they own from private or from bailed out nations. So that's Greece, Greece, Ireland, Portugal, etc. So someone's just asked me about global inflation and whether or not all this kind of QE talk is going to just stoke inflation and cause, a bigger problem down the line. Now, there's some interesting things. Obviously, let's go back to 2008. We saw a lot of QE. We haven't really seen too much inflation, apart from the UK, of course, but a lot of that inflation has been down to other things, not really QE generated inflation, because business activities levels in the West are still quite subdued. Commodity prices obviously have been inflated, so that could be one of the impacts from QE. But right now, it seems like commodity prices, etc., haven't really been impacted by the latest threat of QE. So whether it's QE2 in the UK or the threat of QE3 in the US, largely because there's more of a fear of deflation at the moment. That if the Eurozone is to break up, there's already potentially a recession in the UK and Europe, or we're kind of heading for a negative quarterly growth print, that deflation is more of a worry. So I don't think, I think if anything, central bankers are going to be quite happy to put a bit of inflation back into their economies. Added to that, obviously inflation does eat away at debt levels. So for some of these governments, and they can't do it too much because that kind of just causes more problems, for selling debt in the long term, but inflation may be no bad thing. But going back to 2008, though, there has been a difference. If you look at China, now China had a huge amount of stimulus in their economy in 2008 to stop them to halt a recession. Now, unfortunately for them, a lot of that money kind of seeped into very unproductive activities and really caused inflation to jump very, very sharply. That's now the ramifications of that are now that have been coming through kind of the last few months, with China putting trying to kind of tighten monetary policy to reduce this inflation, which is having a dampening effect on growth. So that is kind of the impact that you could see going forward. So China is quite a good case study for that. Now, just before we go, we've got another 6 minutes or so. I want to show you another couple of charts. I want to show you the CAD chart. Because as I said, not only is Switzerland being impacted, the reason being impacted by the kind of Eurozone debt crisis, but Canada is as well. And they the Bank of Canada kept rates on hold yesterday. There had been some expectation actually that they would, sorry, bear with me one moment. There had been some expectations that they would actually, that they could potentially cut rates. And hence you saw, the dollar CAD actually start to strengthen at one point. Then when they didn't cut rates, we saw it kind of drop very, very sharply, missed that 102 level, and the dollar CAD is now kind of back below 101. That's interesting, I think, because it really does show you, yes, they sounded very worried about what's going on in the Eurozone. However, they weren't willing to cut just yet. So that's lent some support to the CAD. As you can see, resistance on the upside here is 100 or 10080, 85. And so on a more short-term basis, it is actually looking, it's at the kind of bottom of its recent range. I draw your attention to kind of the MACD and the RSI. Both suggest kind of a bit of sideways movement from now on. But certainly on a more longer-term basis, as you can see, it's now kind of breaching this level here, this 10085 level. The next level below that is kind of parity. So we're approaching some key levels. So as you can see, kind of 10040 and then parity really, which is the 100-day moving average. So it is below some key moving average levels here. And on the daily MACD and RSI, the daily directional indicators, as you can see here, they are turning lower. So it suggests that on the longer term basis, there certainly is more expectation for some further weakness in dollar CAD. So that is worth watching out for. And parity could be the next on the horizon. Now, someone's asked for Aussie. So let's take a quick look at the Aussie. Now let's go backwards. So this is a daily chart. This is a long-term chart. So as you can see, within its range. Hourly. This goes back about 2 weeks. It's looking pretty strong. We've also had Aussie GDP out today. We've had some we had an Aussie rate cut as well on Tuesday. We had Aussie GDP today for the third quarter, and that was stronger than expected at 1%. And then here is the short-term chart, and as you can see, basically from this move here was all about that GDP move. So as you can see, stronger growth, surprised on the upside, and they hadn't been expecting that, that's for sure, caused this kind of big jump up. But that 103 level, as you can see, has really acted as very, very strong resistance. Let's look a bit more at this, because I think this is worth pointing out. So really, for the past kind of 2 weeks, it has capped gains, and as you can see, it's getting a bit sticky above there now. So let's take a pointed figure chart for Aussie just to see kind of, above 103, what do we need to do? We do think that it will probably trade sideways for a bit, certainly in the very short term, depending until we get kind of the ECB meeting and the EU summit out of the way. However, we do think that actually it will move more in line with the euro dollar. So what's good for euro and overall risk, since Aussie dollar is one of the most highest beta currencies, that's going to be very, very sensitive to what's going on in overall risk sentiment. So again, if we're headline watching, and there's a lot of kind of headline risk then for the Aussie. So I'm just going to look at Aussie. I'm going to look at the pointed figure chart purely because I like looking at them. And secondly, I like looking at them to get levels. Those of you who joined me before will know that. So here is the Aussie. This is the historical pointed figure. So it goes back a year. So as you can see, again, it's all price. The one thing that's missing on the horizontal axis is, of course, time. So it strips out time. So each of these little boxes represents a price. So it's pure price. So it's weak within its longer term range, but let's look at it intraday, and it will be strong when it comes up. Just bear with me one moment. Right. Bear with me one moment. Great. So now you see the intraday ones. This is just 4 days of prices, really. And as you can see, really, really nice uptrend there, but it is getting stuck a bit at 103. So the kind of the level above that, would be, now 103 also, I'd like to point out, is the 100-day moving average. So this level here is kind of a key resistance level. And then above that, you're really looking at kind of, your 103.50, 103.90, and then the kind of the 104 level, or 104.15 level, which is your 200-day moving average. So as you see, very nice uptrend, however, looking really, really good there. Much less kind of, this is a pure risk trade, really, the Aussie at the moment, because it's got such a high beta to risk. So what it's really showing is that, yes, the euro is kind of flopping around a little bit, but when risk is on, the Aussie really is the thing to jump onto because it does tend to rally quite strongly. So I think that's about it from me. Thank you all for joining. Thank you very much, everybody, for joining. I'm not going to be here on Friday during that summit. Unfortunately, I booked that off way before the Eurozone had got its summits organised, which is a real shame. However, do kind of check our website. We're going to be kind of updating it all the time. If you've got our platform, then take a look at the Forex Insider. Also, I'll be back on Monday, and I think, that will be the real day, when the dust is settled and we're looking at kind of what's going on. So again, thank you very much. And as I said, don't join on Friday because I'm not going to be here. But I'll see you again on Monday, hopefully, and good luck trading. Bye bye.